right, welcome back, fellow safe investors. In today's topic, we're talking about bonds. And I'm not talking about the bonds between us. I mean, I know you feel it, it's there, but we're not talking about those type of bonds. We're talking about corporate bonds, treasury bonds, municipal bonds, and all type of bonds that you can invest in to diversify your portfolio. If you haven't already watched the video that I've released on YouTube called How to Diversify Your Portfolio, I'll leave the link in the description below, or like an info tab, one of these corners. I don't know yet. I'll decide pretty soon. But let's get right into it. And pretty much how a bond operates is, if you ever been to the bank or a car dealership to pull out a loan, you have your principal and you have interest rates. It's the same thing with a bond. So understanding bonds is really easy. You have an issuer, a person that issues the bonds, and you have a lender, a person that purchases the bond. So how a bond works is, if I'm the issuer and I'm issuing a bond at face value of $1,000, and let's say I throw 5% interest on there, bonds pay out monthly. They can pay out monthly, quarterly, which is every 3 months, semi-annually every 6 months, or annually to a year. But in this case, we're just gonna say semi-annually. So I issue a bond $1,000, 5% interest, pays out semi-annually, and it matures in 3 years. So every 6 months, you're gonna receive 50 bucks. After 3 years, you'll have $300. And when you get that $300 at the end of the mature date, you also get your $1,000 back on top of that. So every 6 months, you get the $50, and then when the bond matures, you get your $1,000 back with $300 profit. You can take an L on a bond. So pretty much the only way that you can take an L on the bond is if the company defaults on that loan. And in order for the company to default on that bond payment, they would probably have to go into bankruptcy. But even in a case like that, you have what's called a secured bond or secured backed asset. So with a secured bond, let's say this company, Carnival for example. So Carnival Cruise just issued bonds to raise capital, and they issued secure bonds. So in the case of Carnival, if they default on those bonds, then you can claim assets, in this case, the ships or anything that they have, to get your money back. Bonds are relatively safe, but you have different types of bonds. So you have corporate bonds, you have municipal bonds, which is like your state and local governments, and then you have treasury bonds, which is the United States government, and they're all different in small little ways. So they all operate the same way, or they have the same principles. But with the corporate bond, you usually get higher interest rates because they tend to be a lot riskier. They have a chance of defaulting on those bonds. And with municipal bonds, you don't have to pay income taxes on that income. Do not pay income taxes on the municipal bond. A treasury bond is the same thing. Now with the treasury bond, the interest rates tend to be a lot lower, since everyone believes that the United States government would never default on a loan. All they have to do is print more money. Who's to say they can't default? I don't know, but it's likely that it won't ever happen. So people buy bonds because it is low risk. So you balance out your aggressiveness in your portfolio with your stocks. So that's the stuff you're gonna grow your income with. And then you balance it out with bonds, just to have some money in a safe haven and low risk, and just to continue to receive some return. Like a lot of 401ks or retirement plans invest in bonds because of the low risk, and also you receive payments from interest rates on those. Now, one thing to note when it comes to bonds is bonds work inversely to interest rates. So usually when the Feds lower interest rates, the prices of bonds go up, and vice versa. And so let's say I buy a bond when the interest rate is at 1 for $1,000 face value, and I'm getting that 1% interest payment from that bond, and then the Fed cut interest rates to 0, my bond is worth more. So it all comes down to supply and demand. It's like I have the supply of a great bond at $1,000 face value with the 1% interest rate, and then you can either buy mine and pay a premium or pay more than what I'm paying, or I paid for it, or you can go and get the one for $1,000 face value with a 0 interest rate payment. So you gotta know that about bonds if you're thinking about getting into them. Bonds are not cheap. So treasury bonds, usually start out at $1,000. So if you don't have $1,000 to invest in a treasury bond, what you can do is look up an ETF that contains treasury bonds. And when it comes to bonds, you usually want to do an intermediate maturity. So you want something that matures 3 to 7 years. You don't want your money tied up in the bond market too long. And the reason being is because of inflation. So usually the Treasury will offer very attractive interest rates on long-term bonds, which is like 10 years or 30 years out. But you don't want to do it because you have inflation, and then by the time you get your money back, it's worth less. So with that said, though, you can invest in something called TIPS. And TIPS is Treasury Inflation Protected Securities. And they have an ETF with TIPS in them also. So TIPS, when we go through inflation, the bond adjusts or pays you out what you would be getting or what your money is worth when it matures. So it's not tricky. It's just requires a little research on bonds, what you're interested in, how you're trying to diversify your portfolio, if you want corporate bonds, municipal bonds, treasury bonds, and what you're interested in. But that's just my take on it. You can find something. If you have anything else on bonds that I didn't mention in this video, leave it in the comment section below. If you haven't already subscribed to my page, hit the subscribe button, hit the like button. Follow me, more videos will come on how to build wealth. On my page, Failsafe Wealth. I'm on Instagram at Failsafe Wealth. And good luck. Let's get it. Let's do it.